Sunday, February 11th, 12:04 p.m. New York time. Good afternoon. I've been doing a little further, deeper charting on the US yields. I definitely got light in what I see more. I think it's worthy of showing, making a video. So we know the price action of the yields affect the US dollar. It's part of the reason for the US dollar price action. Looking at a 5-year chart, weekly candles of the US dollar. This past week, US dollar on the weekly candle made a red candle. Yeah, it made a higher high, higher low. That's a bearish pin bar. And look where it's occurring at. This is an impulse move down. Big impulse move down, above average trading week at high and low. A lot more price activity than many other times. So I labeled a midpoint. And we stopped right there. Yep. Bearish pair point, bearish pin bar. Look at this one here. That was even bigger. And look what happened. Reversal. So again, the trend has not reversed here yet. The trend is still up because it's making higher highs, higher lows. But seeing this ahead of time, be looking for a trade idea. Yep. One way to see potential trade idea if we get a break below that low. It could be a day trade, a swing trade. This may be a US dollar blow off. This might be it. Not necessarily the high for the year. May come back and retest that. But if that plays out, it'd be interesting because the correlation with the yields. Let's even do a Fibonacci. See top of this trend, bottom of that trend, what percentage did retracement at? Okay, did a 0.618. If you're not familiar with Fibonacci's, the rule is if it does a 0.618 retracement, that deep retracement means the higher probability that when it goes back, for this one being bearish, when it goes back down here to the bottom, less likely it's going to break. Yep, so you'd be looking down there for it to come down on weakness, and then you're looking for the opportunity to buy it. Again, but a lot of opportunity to make money on the downside. Yeah, but definitely did a deep retracement. Again, many people were looking to trade short since last year. They thought this low was going to be taken out. Even this year, many people were saying it's not sustainable from the beginning of the year. Well, they kept on going higher. They were wrong. Let's take this to the intraday. There we go. On the daily chart now. The past several days on the daily chart. Yep, interesting. So what happened here was that green candle on Thursday tested up here. See that big wick? Tested price action up here and failed, rejected it. Again, one could consider taking a trade out there on a break below that green candle. Maybe we have a panic selling. And then potential target down here in the midpoint. We have a gap down here too. Hasn't been filled. Again, potential targets on the downside. Let's take it intraday on the 4-hour. Looking at 10 days, 4-hour candles. So this past week, huge consolidation, but lower highs looking weak. And then here, this consolidation, buyer stepped in again. But look at these last two 4-hour candles, inside candles. Got a wedge there. Yep, it's a wedge. There we go. That's a wedge. For a breakout for a trade idea there. Also these key levels. Swing high, swing low. Opportunities off those. That's part of the video on the trade with the US dollar. Let's go look at the yields now. Yields reflect the interest rates. Yep. US Treasury offers many financial fixed income products. This one being the 30-year yield. Look at that low for the past 10 years. Sorry, past 5 years, the low. And last year was the high for the past 5 years. Again, yields reflect the interest rates. So on this 30-year, here's the high of last year. Here's the low of last year. We're still inside the range. It's a real tight trading range this year. So notice this low, beginning of the year. Then we went up, did a retracement. So this is a swing point. I labeled here this blue line. That candle. Higher lows. So momentum's to the upside. The yields the momentum to the upside. Yeah, maybe Fed raises interest rates next. But we know what's been going on for the past, what, year? Over a year now? Yields have been left unchanged. They didn't stop raising them, lower them. They just left them unchanged. That's the difference. So swing high, potential target up here, or a trade eye there, testing this. That's the 30-year. The 10-year yield. Different, right? Let's go back here again. Here's the low of the year on the 30. Now looking at the 10. Look how close we are to the high of the year. On the 10, the 5, a little bit further away. The 10 yield, financial instruments, is the best one I consider to trade on fixed income products on these yields. Yep, the 10-year. You could trade the notes. There's different financial exchanges it trades on, from the futures to the stock ETF. And look at this impulse move down here on this 10-year. So potential areas to look for a test. Trade eye there off the high and there. And now looking at the 5-year yield. This past week made a new high for the year. So the shorter duration yield made the new high for the year. Again, big impulse move down there on that week. And now we're looking at the 2-year yield. It also made a new high for the year. So again, the shorter durations made the new high for the year. The 10 and the 30 are just shy of testing the highs of the year. Okay, look at that impulse move down. So taking this to the faster time frame now, this was the weekly. Let's take it into the daily now. And on the daily, I'm going to actually use the bonds and notes, the financial instruments you could trade. The yields, they just reflect, again, what the current maturity rate is, the yields, the interest rates. But it's actually the bonds and the bonds and notes that are the physical instruments you could trade if you have access to the futures. So again, here we're looking at the 30-year bond. Remember, bonds are 30-year. Lower duration are notes. And then less than 1 year, they're like T-bills and other names. But they're all U.S. Treasury financial instruments, fixed income. Just different names based on the yields and maturity. Yeah, so looking on the daily, again, the bonds and notes trade inverse from the yields. So we saw the 10-year, the 30-year, and the 10-year yield. We saw them just shy of highs for the year. We saw the 5-year and 2-year did make new highs for the year. So looking here, yep, you could trade this. You could trade this in the futures market, and the exchange market, and the options market. When I say exchange, I meant the equity index. And here's the 10-year I mentioned again. It's a little different here. Let's go back here. This is the 30-year bond. It did not test the low of the year yet. Neither did the yield, remember? But looking at the 10-year yield here, it already made a new low for the year. Yep, there's divergencies. And now looking at the 5-year note, same thing. Made a new low for the year versus we know the 5-year yield made a new high. And the 2-year note also made a new low. And the major one, I choose to focus on the one that has the best liquidity, the 10-year right here. Trading this. Let's take this to the intraday now, down to the 4-hour. So we're looking here on the 4-hour charts. 30 days, and each candle 4 hours. And the one here is the 10-year. Looking here for trade ideas. Q in the drawing. On a faster time frame, I'm having these key price levels with big round numbers. Show a comparison again. Again, looking here on the yields. Yields, the weekly chart. Put in comparison again. This is the 10-year yield. Happens with 5-year chart, 5 years of history, each candle of the week, and the 10-year yield. Just shy of making a new high for the year. Again, potential trade idea, potential bearish trade idea up around here, up around here. Using the yields charting. So we're looking for a reversal. Take it to the financial instrument you might consider trading. The 10-year notes. Well, again, looking for that key level. Watch the price action down here occur, triggers. And if you don't want to use the ZN, there's also the micro. The micro right there. Well, again, key level on the intraday here, looking for, look at this, for the past 30 days. Swing high, swing high, swing high, rejection. Yep. Maybe get a pop and a fake out and a reversal. For opportunities to trade swing trades, you can trade the futures, you can trade the options. I still don't see the Federal Reserve raising interest rates this year, nor lowering the interest rates. And certainly on the price action, I showed you on the weekly, yields are going higher. Again, they don't have to raise the interest rates, but I don't see them. I just see them leave them unchanged, as I mentioned the past several months, and they have plenty of opportunities to still trade these. It's the dollar that's interesting. So again, if you don't want to trade these yields, certainly do the dollar. Yep. So those are several trade ideas and what I'm seeing occurring here. Again, it's very important to be following the yields, not just the Magnificent 7 stocks or cryptocurrency. Really important, I believe. Again, look at the yields, look at the currency. But most of the news is just talking about the stock market all-time new high. And they're not defining the difference, the correlation with the dollar and yields. So I'll leave it a little bit more detailed. U.S. Treasuries, fixed income. You can buy U.S. Treasuries, fixed income. You don't have to be concerned about the volatility of the equity market. Because again, equity market typically for 2 reasons. You're buying the stocks either for dividends, because you don't think there's going to be growth, or you buy growth stocks because you think your stock's going to be a rocket ship, like Apple, Microsoft. Yeah. So again, there's different kind of stocks for different investment purposes. And we know the yields are for fixed income. Plenty of institutions, being U.S. financial institution, banks, businesses, individuals, pension, hedge funds, other countries, as well as the U.S. Social Security Department also buys. Here's pension. The Social Security also parks money into treasuries and making interest on the treasuries. That's a fact. The U.S. Treasury Department disclosed that a long time ago. Don't know what your media sources might tell you, but again, follow the money. Thank you as always for spending just a little bit of time with me. That's it for the video. Thanks for watching.